It's about that time of day again. Welcome back to your nightly newsletter, boys and girls. Joseph James here. It's Thursday evening, October 20th, 2016. Crude oil is bearish with a spike in channel. E-mini S&P is trading in the middle of a range, while gold is range bound and trading just below the range. And of course, the euro is bearish and trading with a spike in channel this evening. We're ready to wrap up what has been an incredible week in our trade room tomorrow, and we have a reliable plan for whatever Friday throws our way. Before we jump into the charts, take a look at the strategy for tomorrow's Friday session. I want to remind you the only place to watch the full-length version of this newsletter is here on our blog at sidewaysmarkets.com. If you're watching the video right now on our YouTube channel, not to worry. There's a link in the description of the YouTube video. Follow that link and come join me here on the blog at Sideways Markets for the full-length version. While you're here, don't forget to join the mailing list. I'll send you an email every evening when our nightly newsletter goes live. Download those charts you see in the video tonight. You can have those charts ready on your computer for tomorrow. Grab your free pass in the upper right-hand corner. If you're not a member here at School of Trade, get a free pass for you guys. Head up in the upper right-hand corner there for your free pass. And don't forget, if you're brand new here to School of Trade, we get a great frequently asked questions page to answer all those great questions you can have about the who, what, where, when, and why we are considered the industry standard in futures trading education. Hope you guys had a great week so far. Don't forget to grab those charts for tomorrow. Today was a great example of how we used those charts from last night's newsletter to benefit us today. Let's jump into the charts here soon. Let's look at the schedule though first here. Tomorrow's Friday, October the 21st. Tomorrow is the third Friday of the month. It is the third Friday of the month. That means the E-mini S&P will be susceptible to contract expiration, right? Or should I say options expiration tomorrow, Friday, October the 21st. Typically, we don't see too much of this, really because Fridays are usually going to be a little bit lower volume to begin with. Like I always tell you guys, we never know exactly what's going to come as far as volume every day. So we come in every morning, 8 o'clock Eastern time, open up the trade room, and take a look at what we're seeing in real time. So tomorrow we have OPEX Friday tomorrow. It shouldn't affect crude, gold, or the euro too badly. It may affect the S&P 500. So be aware of that. It is the third Friday of the month tomorrow, so be aware of that for OPEX. And of course, please don't forget, we got 8:30 news tomorrow. That's pretty much the only thing on the calendar for tomorrow. So Friday's going to be an early in, early out. It's always a bit of a variable. Sometimes Fridays are really, really great long-term, all the way from the beginning of London all the way to the close of the U.S. session. But typically, though, you're going to see volume start to tail off about 10:45, 11 o'clock on Friday. So keep it simple tomorrow. Get in early, get out early. Be aware of that possibility for low volume tomorrow with kind of that OPEX self-fulfilling prophecy tomorrow. And again, I wouldn't expect that to be anything more than on the S&P tomorrow. And we got some minor news at 8:30 a.m. Eastern time. All right, looking good for that. Again, early in, early out. And of course, we'll be with all of our students tomorrow real time in our trade room at 8 o'clock Eastern time. And we'll do it all together. We'll go crude, E-mini S&P, gold, and of course the euro tonight. Let's kick it off with crude. Crude is bearish with a spike in channel this evening, but we're seeing the sellers struggle to finish off the measured move, which tells the sellers it's most likely time to take their profit and wait for a chance to re-enter this market up at overhead resistance levels tomorrow for a much more reliable opportunity back down again. The sellers clearly have control, but after two attempts to push to the lows, they appear to be running out of gas, which means they should be prepared for either a short-term range, right, around this 50-48 area, or a strong break lower for a run to that measured move. Sellers would love to either sell back at the projected range highs or look for the breakout pullback below the gap at 50.44. Buyers, on the other hand, have zero proof right now and need to wait for a strong break higher and then hold a pullback above the highs of that range, but it's going to be a big challenge for the bulls with all the overhead resistance waiting for sellers to gobble it up and keep shooting for that $50 a barrel target tomorrow. It definitely feels like there's a bit of a fix in to get back to 50 tomorrow, but of course, as I always say, we have to trade what the market shows us every day. I can see that $50 a barrel kind of shaking its head at me right now. Measured moves down there at 50.05. The big round number, of course, is staring us square in the face. Prior week low, I want to make sure I point that out at 49.58. Those are going to be the targets for those sellers tomorrow. The target for the buyers tomorrow is going to ultimately be back at the high of day. But of course, as you can see, they've got quite a bit of work to do. The top of this range is the first spot where those sellers will be looking for an opportunity here. Then, of course, we go to the correction zone up at 51.09, the battle zone at 51.14 up to 51.30, and the last resort here for those bears up at 51.45. This is a great example, though, of a market that just fell out of bed. We talked about this last night. Real strong move down. We were expecting this today. So it didn't really catch anybody off guard. We've got that bear spike in channel you can see here. And we're rotating off the high, trying to find our way back down to the low of this spike in channel. And I'll tell you right now, this is not what those bears want to see. First of all, they try once to break through, right? A cute little wick there, just dipping its toe in the water. You know, that's one thing. But then they followed it up here with some strength. Look at the size of this red candle coming down. But almost as if it was a market mistake, almost as if there was a string tied to it that says, whoop, let's go right back up where we came from. They leave everybody hanging down there. The bears don't even trigger below that candle, and we're off to the races here now as we open up in the overnight Asian session. So at this point, this appears to be one of those kind of classic examples where, you know, we get a real strong bear trend on the way down, but then rather than making new lower lows, we start to find this trading range. It's still a bear market. I can't be a buyer until we see some incredible strength here. So we have to assume now that sellers will be looking for to sell the high of that range, sell up at these areas of resistance, right? So be thinking about selling opportunities at the range high, at all of these prior resistance levels overhead for a move back down. The bears are definitely here, but they're probably not interested in selling low anymore and want to reload the guns right up above that 50.94, 51.09, 51.14, 51.45, all those areas we talked about before. So if I'm a bear right now, I'm looking for one of two things. Either we go up, back down, or real strong breakdown, hold below that gap, hold the high of that channel, and make that run down to that measured move and that big round number. If I'm a buyer right now, boy, this is not going to be easy. I can try to buy the pullback on the way up to the high of the range, but that's a very, very tight quarters, and I wouldn't think that's going to be the most reliable. Normally, what I would say is let's get a breakout pullback above the high of that range. But as you can see, though, now we're running right into multiple areas of resistance. Really, if I'm a buyer right now, I either have to get to it quickly now, get it above the high of that range, or above the battle zone. These are going to be the three areas where I can be looking to be a buyer, and none of them, until we get above that battle zone, really make me too excited about being a buyer, especially in the sense when you look back in time here, we didn't get any traps above any of these prior swings here. There's a lot of sellers here, I would imagine, that have been moving those orders down, right, just waiting to get filled, right, as soon as it pops its head above water. So we're looking at this as a bear market right now. I would think here buyers, again, want to get to it here quickly, or I'm looking to be a seller up at these highs here. Buyer failure, back down. Buyer failure, back down. Just be aware if we do end up into this area here, this will become a short-term bull market. And so you want to be looking for situations like this, right? Buyers hold the pullbacks. Buyers hold the pullbacks. This is where you can look for that buyer failure, right? But that'll be that lower reliability trade. Strong breakdown, hold the pullback, right, and back down again. So buyers are looking for those pullbacks either quickly above the range. Sellers then are coming in for buyer failures, right, pullbacks for the move back down. Obviously, if it does keep going there, right, if it does keep going there, then again, that'll be another spot there, right, for those bulls. If it does just collapse lower, you know, heck, there have been crazier things that have happened, and there's a big round number staring you right in the kissa down there at $50 a barrel. So if it does push lower, the one thing you want to keep in mind is to get that moving average down below that gap, right? I want to see a strong break lower, right? That's kind of the rule of thumb here. Strong break lower, and of course, my way of defining the term strong is I want to see it really strong break lower, big enough move down to bring that moving average down, and that's kind of the line in the sand there right, to get that gap fill, stay below the high of that channel. What you don't want to do is get that move down, try to sell, but now you're selling above the high of that range, right? That's not going to work. Buyers will be waiting to gobble that right up, right, and bring that back higher here. So targets on the way down, 50, keep an eye on that 49.58. You know what you're looking at for the breakdown. You know what you're looking at for the break up. Buyers got to get to it really quick, right? Either get to it now or pick your spots above the highs and above the battle zones. Sellers are looking for those failures to send this price right back down. As we go higher here, the initial target is to go back and retest the low. Then from there, breakout pullback down to the 50. From there, breakout pullback down to that 49.58. And again, when I say breakout pullback, I use that moving average as a very easy way to determine if we have enough strength. Let's keep going here. Boy, that S&P here looking really range bound. No major news tomorrow, but we do have OPEX, like I said before. Right, we do have OPEX tomorrow, so this might be a little bit of a analysis paralysis ahead of OPEX. But typically OPEX is a whole lot. Typically OPEX has it's a whole lot of show and not a lot of go. The OPEX you want to be watching out for is going to be quadruple witching OPEXs, which of course have a much more dramatic impact on them. Those are the months of March, June, September, and of course December. So we're not there right now. This is not a quadruple witching week here this week. So tomorrow is just kind of your run-of-the-mill OPEX. But this market definitely shows us a sideways range-bound market, trading right in the middle of a range this evening. And the recent pendulum swing below the range tells us to be looking for a move higher before we get the opportunity to sell the highs back down to those lows. Our plan for a trading range, which of course we talk about quite frequently here in this nightly newsletter, if you go to my blog right now and just use the search box for trading range, you'll find all the newsletter videos, right, for trading ranges. So our plan for a trading range is to buy low, sell high, and avoid the middle while focusing on failures to get into the moves properly. And keep an eye on an explosive breakout move, because those are likely going to be the sign of a new trend tomorrow. So until we see ultimately, until we see the market break out of the range and then get something like this, right? You want to see explosive move. Now, this obviously went from top down to bottom, but imagine now if we end up going back down and then we start seeing that explosive move. That's the type of real explosive move I'm talking about. Real strong, one of those moves where you just step back and kind of watch and just think, wow, this is an incredibly strong move. It's out of the normal price action that we see. So looking for a real strong breakout. Other than strong breakouts, we're looking to fade this move back up. As you can see right now, we have that pendulum swing. There's your trading range. And of course, we swing outside the range. Imagine there is a balance right at the 50% area of that trading range, right? The sellers take it lower. They rotate back up to the high. Here's a really big clue here. What happened here, right? Why didn't they finish the rotation back down? It may be because this big move is being seen as a short-term buying opportunity for the bulls, right? And they're buying this thing up. Again, the pendulum swinging all the way back down. We don't quite know enough about it yet to know if we're going to get that pendulum swing all the way, but it definitely tells us that if we do see this market jump higher here, we've got great levels of resistance here waiting at the measured move and the pendulum swing. So scenario one, we go up to the high of that range, buyer failure, and back down into the range. Target, of course, is back at the low of the range. Right, that'll always be your most reliable target, selling off the high, back down to the low of that range. You can take a piece of it off in the middle if you'd like as well. That's also a very reliable target back in the middle. As we go back in the opposite direction though now, right, assuming we go back down now, right, sellers try and fail, and back up again. Again, take a piece off in the middle, right? Your ultimate target, of course, then is back up in the opposite direction. Remember, the most important thing about trading a range is always to let it dig into the highs and the lows. So for the buyers right now, the buyers are trying to get up into these pendulum swing areas here, and then sellers, right, taking it back down into that range. Sellers, of course, got their eyes on that 26 3/4 area, get it down just outside that range low. Sellers can't hold, right, and buy it back up. Remember, the only scenario where we're not looking to fade buying the low with seller failures, selling the high with buyer failures is going